Hello, ladies and gentlemen, and welcome to day 2 of GlobalCapital Sustainable and Responsible Capital Markets Forum. This first panel of the day focuses on the response from Asia to the coronavirus crisis and the important role the capital markets have played in tackling the pandemic. Amid a crisis such as what we've seen this year, ESG and SRI-focused themes have never been more important. I'm sure all the issuers today will talk about that in great length. More and more issuers in the region have realized that and have been selling COVID-19 response bonds or sustainability bonds, where some of the funds go to fighting the pandemic. Investors are also increasingly keen to ramp up their ESG portfolios. And we've got multilaterals like Aiib and the IFC, both of which are represented here today, that have mobilized resources to government and a number of companies to help them mitigate some of the impact of the health crisis. So as you can imagine, we have lots to discuss in this session, and I have an esteemed panel of speakers with me today to debate on some of these latest developments. So joining me are Martine Hagen, Head of Funding at the Asian Infrastructure Investment Bank. Also in the panel is Jing, Head of Sustainable Financing at China Construction Bank, which has played an active role not just in issuing green bonds, but also investing in some of these bonds in China. We also have with us Christina Ongoma, Principal Investment Officer and Upstream Lead for the International Finance Corp's Asia Pacific Financial Institutions Group. In this role, Christina oversees the origination and execution of new private sector solutions to tackle development challenges in the region. Ongoma is dialing in from Washington, D.C., so she's having a very early start to her day. And lastly, we have with us Jason Mortimer from Tokyo. Jason is Head of Sustainable Fixed Income Investment and a Senior Portfolio Manager at Nomura Asset Management. Thank you all very much for joining us today. Before we start, a quick couple of housekeeping rules for our listeners. If you have any questions during the session, please submit the questions through the chat box, and we'll tackle them at the end of the session. The panel is set to last about 45 minutes, which will give us 15 minutes at the end for the Q&A. Let me get straight into it and start with a question for Jing. China's issuers were the first in the world to roll out COVID-19 response bonds onshore this year. Can you talk to us a little bit about how these deals emerged and what role did the big 4 Chinese banks, including CCB, play in getting that market going?
Well, thank you, Rashmi. Well, it's my great pleasure to join this panel discussion on the capital markets reaction to COVID-19 crisis in Asia. Well, I would say this pandemic posed a great shock to the capital market here. We have seen that since the coronavirus was first detected in late January this year, bonds issued by Asian issuers were under great stress, especially during the dollar stretch in March, with some of the speculative bonds traded about 15% in the offshore market. While in China's domestic market, however, things were a little bit different, because when the virus crisis mode was switched on, all market players were off work for the Spring Festival. When they were back to work, the whole society began to synergize and do whatever everyone can to combat the impact of virus crisis. And the bond market in particular, with policymakers injected ample liquidity, there came up with this coronavirus bond to address the financing difficulties. So basically, we didn't see a shutdown in China's debt capital market during the hardest time, but a significant pickup in issuance volume instead. What I would add is that the coronavirus combating bonds that emerged in China, however, is very different from the pandemic bonds or catastrophe bonds issued by the World Bank in 2017. While the purpose of the coronavirus bonds in China is to finance the virus control projects and businesses and to solve the liquidity issues of the virus affected areas, especially the enterprises there, for example, in Wuhan. And it is a kind of emergency response and risk mitigation measure rather than an incentive to encourage progressive virus control actions. So the creation of such bond is actually due to a top-level design from Chinese policymakers for developing a new channel and direct the funds to the virus-affected real economy. Since you know, until now, the credit bond market in China is still a regulated market. And the first coronavirus bond in China was issued by a state-owned enterprise called Zhuhai Huafa Group with 15% 50% of the proceeds used for virus control projects and business, and the other 50% for refinancing. The issuance amount was 1 billion RMB with 3 months tenor and issue on the 5th of February. Also, a medical company, Kelun, issued 0.8 billion for 9 months on the same day. It raised the issuance amount from the planned 0.5 billion to 0.8 billion due to the exceptionally large book orders from bond investors. China Construction Bank had set up a 10 billion RMB special fund to invest on these coronavirus bonds as an additional approach besides the traditional bank loans to support our major clients during this difficult time. For financial institutions, on the 6th of February, China Development Bank and Exim Bank of China had issued a total of 18 billion RMB coronavirus combating financial bonds. Since February, there had been 54 billion RMB of coronavirus bonds, which was about 1/10 of the total credit bonds in China. And the majority of the proceeds were used to support the enterprises that produce virus combating equipment and facilities, as well as to alleviate the liquidity concerns of these enterprises under virus crisis circumstances.
Can I just interject there? Sorry, Jing. You mentioned that CCB has set up a 10 billion renminbi fund to invest in some of these COVID-linked bonds. What kind of criteria do you use when it comes to picking the bonds that you want to invest in?
Well, for CCB, since we normally do not issue bonds in the domestic market, under the special circumstances, our main devotion to support the coronavirus control would be our investment in the coronavirus bonds. For this special fund, we prepared a list of high potential companies that may need our investment support, and our investments will mainly focus on short-term bonds. By now, most of our coronavirus bonds were due. So with bank loans and bond investments, we managed to better support the real economy to overcome virus difficulties. As for the structure of the coronavirus bonds in general, non-financing enterprises issued 60% of the coronavirus bonds in China, about 22% of which were issued by local government financing vehicle to finance the virus control actions by local governments. These issuers mainly from energy and utility industry, which is dedicated to the important suppliers such as gas, power, and water, and the transportation and logistic industry, as well as the manufacturing industry.
Okay. I remember when the first bonds emerged, there were some concerns that these deals were being used by a lot of the issuers because it was easier to get approvals for them, and that the majority of the funds were actually going for non-COVID related financing. What concerns did investors have at that stage in terms of viewing the investment potential of these bonds when the proceeds are not necessarily earmarked for COVID?
Yes, the coronavirus bonds in China may be far from perfect, especially from an international comparison angle. For example, the point that you mentioned, not the 100% of the proceeds were used for the coronavirus control. And also there were no clear and straightforward standards in terms of what can be labeled as coronavirus bonds. The NAFMI of the interbank bond market and the CSRC of exchange market, as well as the NDRC, all had different guidelines and criteria. Actually that makes quite some confusion among investors. But to my understanding, I would say, first of all, we do need to focus on the emergency feature of such bonds. The sudden arrival of coronavirus and the immediate impact on the economy actually won't allow anyone to spend ample time to set up a perfect principle, but to prioritize the the urgency first. And also, China's policymaker had the advantage to review and identify the real coronavirus funding needs firsthand, so they can kind of make sure that the issuers' virus control needs are real. That's the first thing. And the second thing is, even though not 100% of the proceeds were used for the virus control, actually the liquidity difficulties of these affected enterprises are also very important. And it's a priority for all the policymakers as well as the financial institutions to solve. So in this sense, we think the coronavirus bonds issuance is kind of balanced, because if you look at the issuance volume during these months, actually the biggest volume emerged during February and March, with each month the monthly issuance about 100 billion RMB. But in April, when the crisis was kind of under control, the issuance volume reduced to about 80 billion RMB. And in August, there were only 1.2 billion RMB. So actually, the coronavirus bonds kind of reduced with the needs to combat the virus.
Okay, all right. Now, thank you very much, Jing, for that overview. Maybe we can move on to Jason to actually get an investor angle on these bonds. Jason, what have you seen when it comes to how ESG investors in Asia have reacted to the crisis? And from Nomura Asset Management's point of view, how do you measure the investment appeal of an ESG-related bond or a coronavirus bond versus a conventional bond?
Sure, thanks very much. Well, you know, as a Japanese investment manager here, our main focus is on Japanese clients and their fixed income needs. And so what we have seen, I think, you know, first an overview. It is quite a different market from China. It is not subject to that level of control by the government. But what we do have and what we have seen is really an acceleration in the number of social bonds that have been issued here in Japan. And I think if you look around also in Asia, outside of China as well, I think this region has been a bit of a laggard, you could say, in terms of the green issuance. But the COVID crisis that we've all faced really seems to have kind of been the Kickstarter for I think for the social bond structure. It's almost, I feel like COVID is to social bonds as climate change is to green bonds in some ways. It really has given the market kind of a big, real, immediate issue to deal with. Many facets, many dimensions to that. And I think we've really seen some interesting ways in which Japanese investors have stepped up to the plate. Some banks have issued already quite a large number of social bonds, COVID-related here in Japan. We've even seen some new issues or talk of new issues from regional banks as well. I think that the social bond format related to COVID, related to all the social issues that's created, the SME funding. Obviously funding for medicines and vaccine research. There's a lot of ways that you can tap into that, and I think the issuers here are really taking advantage of that. One of the other really interesting and innovative bonds that I think has come out of this or is being talked about now is there's a kind of a regional, it's a government-linked agency that basically does urban development, and they are going to do a social bond related to urban development in sort of more of the rural areas in outside of Tokyo. The idea here and the link to COVID is that with social distancing and work from home really becoming a big trend here, there's the potential to actually see maybe population flows back to those regional areas where you've seen a lot of depopulation. As you know, of course, Japan also faces an aging and shrinking population. So that's another interesting aspect, I think, to this, that you've started to see how the COVID crisis has kind of dovetailed with a lot of other issues that Japan and other developed countries especially deal with. Work from home, more flexible working arrangements for workers here. This is something that it all kind of comes together and gives our issuers something to talk about, and issuers and investors also something to talk about for their bond investments. So, to answer your question, there has definitely been an increase in interest from the issuers. We've seen a lot of more innovative things coming out of the social bonds related to COVID, and also the investors as well. They've been starting to ask more for COVID related relief for social bonds, and even on the retail side. I think it's really starting to pay off now. We've done a lot of education in the market, tried to do a lot of education in the market about what is ESG, what does this mean? Does this hurt returns? Is this good? Does it work even for bonds? And now you're seeing, with some even retail bonds coming out for the COVID social bonds from a particular bank. The retail side also, they know what this means now. They're ready for that. They're very receptive to that. So I think it's all very, very, very good. I mean, out of crisis, something positive has come in Japan.
Are the issuers able to find any pricing advantage at all by selling these social or sustainability COVID-linked bond at all versus a conventional?
Right. Well, as you know, in Japan we have very low. It's a very kind of unique market. Especially on the fixed income side, it's a very very supply volume constrained market. Typically, very high rated issuers. So I think that there's been a lot of research into what kind of pricing that you might be able to get out of this. I think that the base level of spreads is so tight already. You're probably not going to be really making a huge difference in that sense. But again, I think it is important. It is good for these companies to show, as issuers and also investors, this is something that they can talk about. This is something that kind of gets people excited, gets people in the door. And for me, and of course for us and our clients, seeing the end investors as well, public pensions, very big ones and also smaller ones, they're now kind of coming around in I think a big way to this market as well. They like to be able to. I think it helps them to be able to talk to their members. What is the investment on the bond side doing? Maybe rather than just sitting in a JGB, now they can talk. This is a bond that is funding this project or this revitalization kind of project somewhere. That's something that's really positive, I think, and I think that's something that's a good way that we can. That's a good direction for us to take this market going forward.
Okay, so no pricing advantage in the primary market. So is there any performance difference during times of these crises in the secondary market at all for these bonds?
Great question. Well, we've actually done some work with Climate Bond Initiative and also the ADB on the quantitative outperformance of green bonds during times of market stress. And we obviously did have another time of market stress this time around in March. And what we did find in our previous examples was that, in fact, green bonds, which we had a lot more bonds to study at that time, they do, in fact, outperform even when you adjust quantitatively for credit, duration, even the same issuer. We were able to really isolate the difference in the spreads. So that is something that we've seen on the green bonds. I think it's a little bit early to tell if the social bonds can really benefit from that. Remember that, especially I think on the Japanese side, the buyers of these tend to be more buy and hold type of long-term investors. So certainly for them, if there's less volatility in the price, that's definitely a positive. But these are not typically bonds that are kind of, I think, really actively bought and sold. So it's still maybe the jury is out on the social bonds, but on the green bonds, we have actually seen a quantitative and pretty significant difference in terms of the performance, especially during times of market stress. And that's what we tell our investors what kind of ESG is for on the fixed income side. You get some downside risk protection, and that is worth something. So we think that over time, that's something that investors will choose. They will put a value on that, and that eventually can flow through to not only the allocation of capital to those types of projects, whether it's green or social, but also to getting a better pricing for those types of issuers.
Okay, no, that's very, very interesting. Thank you very much. Before I move on to the next question, just a quick reminder to our attendees and our listeners. If you do have any questions, please submit them through the chat box during the session. And we will have about 15 minutes at the end of the panel to tackle some of your questions. So please keep your questions coming. Perhaps moving on to Martine and Christina. Martine, from an AIIB perspective, you've obviously had a very first-hand look at the way various countries are tackling the coronavirus crisis, and AIIB has played a very active role in tackling the pandemic as well. Can you maybe talk to us a little bit about your experience this year from a funding perspective and what more we can expect from the AIIB?
Yes, of course, and thank you very much for having me on the panel. When the coronavirus became a pandemic, to Jing's point, AIIB staff were, on Chinese New Year holidays scattered around the globe. And it really, was for us to immediately turn everything around and, gather ourselves and, get that work from home in place. And what we really wanted to do first was to put something together that would really help our members almost immediately. Because, as you can imagine, many of our most vulnerable members have been the ones that have been so direly impacted by COVID-19, and it was really essential to be able to help with what they really needed. So that was the beauty of being a young multilateral development bank. We were able to be nimble, and we went to our board to ask for a crisis recovery facility that was actually quite different to our normal financing operations. Our normal financing operations, as you can imagine, as an infrastructure multilateral development bank, there were things like energy, transportation, sustainable cities, not quite what would help our investors today. And so we asked our board for a crisis recovery facility that would allow us to lend to things like healthcare infrastructure, for economic resilience and for liquidity needs. And so back in April, we put the crisis recovery facility in place, and it started off with a size of $5 billion US, very quickly moved up to $10 billion and is now at $13 billion. And so when it came to AIIB wanting to access the markets, in May, we were going to be doing our first SEC registered global of the year. And we really wanted to reflect the COVID-19 or the crisis recovery facility in that bond. And so, and just to mention, all of AIIB's bonds are sustainable development bonds. And so this was something that we wanted to add on in addition. So when we went out on screens then with our $3 billion 5-year SEC registered global sustainable development bond, we also put the details of our crisis recovery facility to show that that bond was also being issued in the context of COVID-19. And I want to say that something like 50% of the investors in that bond came from the Asian region. And we also saw increased interest from more specifically ESG investors in that transaction than, say, our inaugural dollar bond from a year before. And obviously then we were looking to be active in the China interbank bond market, and we came with our debut Panda bond in June of this year. And when we were putting the documentation together for that transaction, we really wanted to have that COVID-19 or pandemic prevention label, the official label from NAFMI in China, because we really felt that the use of proceeds on this bond really were going to be used for the COVID-19 pandemic prevention. And we were at that time just about to disperse our first crisis recovery facility loan, which was actually a financing to China for the healthcare infrastructure in 2 of the municipalities here, both Beijing and Chongqing. And so we really felt that having that label, even though we are aware that there are differences in terms of use of proceeds and transparency around that in the on and offshore markets in Asia, for us having that label really was reflective of the use of proceeds on that bond. So we were very happy to have that done. And then with regard to the rest of AIIB's financings, I mean, this year already we have approved more than $6 billion of crisis recovery facility loans to our members, and we have at least another $3 billion in the pipeline. And so we are very likely to have an increased borrowing requirement this year specifically to meet the disbursements under the crisis recovery facility. So absolutely you will see AIIB back in various markets, including another dollar deal at some point in the coming weeks.
Okay, thank you very much. On your point on your SEC registered global bond and the response that you saw particularly from ESG investors, since then and since then when you're having discussions with investors on a frequent basis, have you seen a big upsurge in social consciousness among Asian investors because of the pandemic?
I think You know, we have probably spoken to more than 90 investors since February on one-to-one calls, and we do spend quite a lot of time looking at or discussing the crisis recovery facility. And investors, they are most definitely, there's a change. We see that there's not just interest now in labeled bonds. There isn't just an interest in what the disclosure is around in a labeled bond. There's interest in what the issuer's disclosure is around COVID-19. So what have you done to support your employees or your customers, or for AIIB, our members, our stakeholders. So we definitely see that that is something that has changed in this market. And we're also aware that quite a few investors over the last couple of years have been putting in that sort of framework to be able to do ESG investing, and that doesn't come without a cost to make those investments in that kind of framework. And so we see that along comes COVID-19 in 2020, and that really helps to validate those investments that investors have made in that kind of infrastructure. And we are seeing that there's much more sort of exclusionary type of activity for particularly Asian ESG investors. So they're looking at things like controversies, they're looking at ESG ratings, whether you have them or you don't, or whether they're good enough. So we are definitely seeing quite a change in terms of investor outlook.
Okay. No, thank you very much. I'm going to put that same question to Jason, given you do work at Nomura Asset Management. Maybe perhaps from a Japan angle, what have you seen in terms of a rise in social consciousness among Asian investors because of the pandemic, or any mindset change among the Japanese investors at the moment?
Yeah, well, on the fixed income side for our clients, I mean, on the active side versus the sort of the more index passive investment, I think on the index side, that's been where most of the kind of labeled bond investment is taking place. Active investors, institutional investors looking at actively managed bond funds, or retail investors looking for like a certain level of yield. It's always been a bit of a difficult one to tie out with the labeled bonds. So that still is somewhat, I think, still, we're not quite there yet in Japan. I think we haven't quite matched off the market with the level of yields and spreads that are required. But what we've done at Nomura Asset Management on the fixed income side, we've developed our own proprietary credit ESG scoring framework, entirely quantitative, both for corporate credits. We cover about 6,000 globally, so pretty much universal coverage, as well as for every sovereign in the world. And we can actually use our sovereign data now to evaluate government-linked banks like AIB, based on the membership and voting rights. So we are looking at these things now from a very quantitative perspective. That seems to be of interest, and something that the Japanese investors that I talk with can really kind of understand. They can see what we're doing. They can see the framework, how it works, how it thinks. It is a model, and it does come up with a score. And when we have actually shown that even in very long-term back tests, 20 years back even, that indeed the companies with the highest scoring credit ESG risk scores that we assign them have in fact been the best in terms of volatility adjusted returns. So Sharpe ratio is higher, and that has also been true on the sovereign side as well. So this together with, I think we've seen a big shift. The shift that I've seen during this time has been that people have really recognized that ESG works. ESG works. It does make money. It does outperform. I think there's been a real mind shift change, globally and as well in Japan. The conversations we have seem to be different, and that for us is real. How we're going to make this sustainable finance truly sustainable, because that way we can take it mainstream, and then we can make a much more bigger a difference.
Okay, now thank you very much for that, Jason. I'll quickly maybe move on to Christina, I think, because your take will be quite different, given you come from IFC's investment side of the business perspective. What has your experience been like in terms of how IFC has helped tackle the response to COVID in Asia? What have been your main focus areas? If you can perhaps walk us through that a little bit.
Sure, thanks a lot, Rashmi, and very nice to be on the panel as well. So a couple of the things I'll say will really resonate, even if I come from a different angle to the talk. I work on the investment side, so we're generally, working with issuers and taking, whatever IFC places in the market and of course applying it to some of our investments. So there's been a couple of things that have happened. In March, we had $8 billion worth of COVID rapid response facility that was approved by the World Bank Board across different sectors. And that is all the way from the real sector, manufacturing, some liquidity lines were there to support existing clients, particularly like, trade and so forth. Some of the facilities, for example, might provide risk protection for trade finance, emerging markets banks. So those have been rolled out, and there has been a real big, uptick in terms of our clients actually using the lines and the facilities. So those facilities were backed by, of course, a big social bond that IFC went out into market in March 2020. And that was the first social bond that the IFC had actually issued off of its social bond program. There was a lot of investor interest. It was, I think, definitely oversubscribed. But what I'm seeing on our side, when we look at all the issuance and some of the discussions that have happened to date, just what it shows me is that there's real interest and a real opportunity to grow this asset class, whether it's on the liability side of the IFC's balance sheet or working with our own issuers. So in Asia, for example, I am leading a new strategy that actually looks at incubating certain ideas and developing markets where IFC can actually find bankable projects. And I think that post-COVID and in the economic situation coming in front of us in Asia and also in other jurisdictions, capital markets are going to be really, really key. And some areas where IFC's done very, very well, for example, are in the green finance or the climate finance space. And we look to, on the investment side, the examples that have been set by the IFC being an issuer and working with others like in the World Bank and so forth, and trying to build on those when we work with our own clients. So, in the green finance space, I think a lot of people have spoken today about, I think that's a market that's really well known. The principles are out there. I think investors have come to actually understand and appreciate, the green bonds, the green bond principles. For social bonds, it's been a little bit, the uptake has been slower, of course, just because there've been less opportunities to put into social bonds or, there's a reporting, the use of proceeds. On our side, when we've worked with our own financial institutions groups, issuers, even outside of Asia, who want to contemplate doing a social bond, typically before this crisis, a lot of it was around gender. So you could have, IFC has had inaugural gender bonds, for example, in emerging markets. But I think now with the COVID pandemic and with a lot more issuers coming to market, we have a good track record, lots of projects that can be financed, whether it is on the liability side of our balance sheet or even on the, on the investment side. And so we're looking to see if we can help issuers going forward in Asia. I mean, like everywhere else in the markets that we work in, because we actually think there will be a lot more opportunities to bring them up the curve with bonds that are actually social bonds and sustainability bonds. Now, this new area I was talking to you about, the upstream area that I'm actually heading in Asia, we realized that after phase one of the rapid response that we've had, which was the $8 billion facility that I spoke to you about, we have to do a lot of hard work to actually attract capital back into emerging markets. And what IFC is doing is looking across the World Bank group of organizations and having a really coordinated response in terms of how they are doing the work going forward, like just in the future. We call this like the IFC 3.0. This is our new strategy, where we're saying, rather than say, there's no bankable deal, so we can't do any investments here, is actually have a very, very focused approach about seeing what the World Bank has done in certain markets, what the meager group that provides, protection, sovereign protection to others. How can we actually look at all these organizations and then come up with really focused financing solutions that will allow us to deploy capital? So when we are looking at any country, and in Asia, there are so many countries where we've said that capital markets will be a real priority for the IFC in this particular sector, and this is on the investment side. We might, for example, look at some of the work that the World Bank has done with issuers in the green financing economy, because we know usually the first issuer in for green bonds and so forth are usually sovereigns, and there's a lot of work that has been done in the markets on the regulatory side. And take that work and then say, what does this mean for us on the investment side? And how can we then take work that has been done in the bond markets with the World Bank, the government bond markets, some of the work that has been done on the climate side, and then build on that and have investments. So recently in Indonesia, or rather it was in 2018, we actually invested in a green bond and worked with an issuer. This was OCBC. It was like a subsidiary of OCBC, and that was a very focused kind of intervention where there was an existing program that was going on in the country around green financing, and our strategy was to take the work that had been done in Indonesia and then build on it and eventually bring an issuer to market, because it's not always easy. Mm-hmm. I think that when you're on the treasury or the funding side, you're facing very developed counterparties and markets, but we want to take those best practices and then bring them into emerging markets. And it's going to be really critical to do this upstream work that we're talking about in a very focused way, because it's going to be challenging. To bring capital back into emerging markets, we have to be creative in the solutions and the platforms that we're offering some of our clients. But I would just say, as what really resonates with me here is that there are so many opportunities now, particularly in the social space, based on the amount of issuers that have come to market since the pandemic.
Okay. And has COVID changed your strategy around this, the upstream part of the business that you talked about? Have you had to tweak it because of the COVID crisis, or was that the case even before?
So I think that, like everybody is saying here, I think the COVID crisis actually brought a lot more opportunities and has allowed us to think more innovatively, I guess, on the upstream side in terms of what, our interventions are going to look like. Obviously, COVID is it's a huge theme for everybody, whether you're issuing bonds, whether you work at multilateral like the IFC. In fact, this is the reason why you need to be in those markets and a lot more engaged in those markets, right? So of course, there's going to be, a lot of, looking at solutions that perhaps are more digital in nature, solutions that are larger platforms so that they can roll out capital much more efficiently across countries. So that's one. Definitely, we would be looking at interesting opportunities together with our colleagues in the manufacturing and infra space to see how we can maybe think about climate, energy efficiency, and so forth, in a way that maybe we don't necessarily do in our mainstream business. So, this cross-fertilization of ideas and working for holistic solutions with our clients around issues like climate, digital, capital markets, and so forth. But ultimately, I think what people understand is that the pandemic has brought great opportunities to work with our clients, but not only that, to think more innovatively about how we are funding, the instruments that we're using to fund, and really, I think giving ourselves really big, I guess, opportunities to think outside the box. Like, what can we do that would be different? And it's being driven by COVID. Of course, there's lots of things that are driving people as they think about solutions going forward. It's not only the pandemic, but are there dislocations in the market? Because obviously you've had a lot of public policy interventions, right? That may or may not dislocate a market, and you don't want to necessarily. You want markets to come back, but you also understand that there's been some interim measures that have been taken that might affect the way you do your work.
Okay. And where do you see the most opportunities when it comes to the Asian countries?
Wow, that's an interesting question. I would say, so looking at the portfolio that we have, right, the way we've bucketed it is that we just have different priorities, and we're driven by, on the IFC or the World Bank side, what we're driven by is, what are the country priorities, right? This is whether it's on the mainstream business or the upstream business. So what have the countries said, and what are World Bank shareholders telling us are their priorities in their countries? And so we start at that, right? But typically, I think that, this is no surprise to anybody, would be things like climate, the SME focus, a lot more focus now, of course, on building resiliency for, in the climate space with SMEs and so forth. Digital and fintech is going to become increasingly important, because I think that, COVID has changed the way businesses are rolling out their services, the way people do work and so forth. So I would just generally say that it would just depend what a country has said is their priority on the World Bank side. And then we just build up on that, whether it's on the mainstream or the upstream business. And of course, capital markets are key, because they're going to be really critical to bringing back capital into emerging markets, and having resilient capital markets are quite key for the way the IFC is looking at business in the future. We have a joint capital markets program right now that runs up the IFC, and it has certain countries of focus. So Indonesia, Vietnam, and Bangladesh, that's a joint IFC World Bank program, and supported by donors as well. And what we do is we have very focused interventions in certain markets and build on capital markets opportunities, and tend to follow through with investments. And that would be public policy work, it would be work in the bond markets, regulatory work. So the whole point is, for Upstream, is actually pulling all these efforts together to have a more focused approach to the way we do investments.
Okay, so then is the expectation then that the more you develop these local domestic capital markets, the better prepared they will be in the future when, again, a crisis like this emerges, that they'll be in a better placed position to kind of be able to tackle it more effectively?
I think that is some of it, but then also, what is important is bringing, long-term scalable finance, and particularly local currency finance into emerging markets. And the best way truly to do that is through capital markets, right? Ultimately, if you can have more issuers, you can have, longer tenor bonds that can finance projects in a more holistic manner without, capital flight, right? Because what happens in crises like these is that, the capital leaves emerging markets. So how can we make it more sustainable? And how can you mobilize capital actually from local institutional investors and so forth? It's actually quite critical, particularly during a time where you have market stress and you have a lot of long-term investors who leave the market. So we know that those markets are key for long-term sustainable finance for some of our most vulnerable clients, as well as, just to build an economy locally.
Okay. All right. No, very interesting. Thank you very much for that, Christina. I think we just have a couple more minutes left to go. So perhaps in one sentence each, if all of you panelists can maybe just share with me what has been the biggest lesson learned this year from the pandemic that you hope will help capital markets going forward. Christina, since I have you in front of me on the screen, maybe you can start.
Oh, wow. So I was put on the spot here. I think that more than ever, just the importance of capital markets, right? For me, I think that's resonated a lot. Where have we gone when we needed, to have a rapid response to problems is actually in the capital markets, right? I think if you can execute efficiently, we got the capital that we needed, for example, to do the work that we had to do in emerging markets, which was really critical at very short notice. Okay, I'm talking from the perspective of, of an IFC, an SSA that generally is in the markets all the time, prices tightly, it's AAA credit and so forth. But I think it's just been, for me, it's resonated really strongly that capital markets are key to a lot. And I think building resilient capital markets, I'm talking about this from the emerging market side, is going to be really key going forward. Yeah, so that would be my take on that question.
Great. No, thank you very much. Martine and Jason, your go.
Yeah, thanks. Similarly, I would say that what's really happened is that we've seen the power of financial innovation and really to alleviate these social issues. So, obviously we've been able to strengthen, public health care, protect health workers, protect jobs. There's been vaccine R&D, obviously, most importantly. So, hopefully that's a long-term positive for sustainability and ESG investing. And if we do think that, the impact this crisis has had, imagine what the impact of a crisis would be based on environmental issues. And so hopefully what we're seeing now is that, we've seen that there are many more issuers who've come into this sort of social bond issuing. So hopefully that they will remain there and that we will see much more, be a real long-term positive for these issues.
Okay, great. Thank you very much. Jason?
Sure. So I think one word that I've been hearing a lot more of recently is resiliency. And I think this is a very important and interesting concept because, up until now, we've really been talking a lot about, obviously, is sustainable investing for the long haul. How do we build sustainable finance systems, economies, societies? But at times, we do have shocks. At times we do have crises. And how do you respond to those? How do you bounce back from that? How do you kind of resist the damage? That I think is also very much part of how you build of sustainability. I think they're very much, resiliency and sustainability, I think, are really one and the same. And I would like to look at ways, how we can, as investors, direct capital to building resiliency, whether it's, Japanese, kind of rural areas, faced with both, kind of pandemics and natural disasters, as well as in, emerging market regions. I think there's a lot of work to be done there on the resiliency side.
Okay, great. Thank you very much for that, Jason. Jing?
Well, we did see a great investment momentum in especially China's capital market. And the coronavirus bond during this very difficult time was seen more or less as a way out for the capital market players to express their support and effort to control the pandemic. So in this sense, this particular type of bond of this COVID-19 or coronavirus bond did somehow raise and consolidate the social consciousness of the bond investor groups here. And we have confidence that the social consciousness of the investment group in Asia will grow larger and larger.
Great. Thank you very much. I think that brings us to the end of this panel. Thank you all very much again, Martine, Christina, Jason, Jing, for joining us for this session. We'll now move on to the live Q&A. Thank you already to those who messaged in your questions during the panel. To all the attendees still listening on Hub, you'll see a couple of links on the panel screen. These links will allow you to join the live Q&A with our speakers immediately. So you can ask the panelists directly any questions that you may have about Asia's capital markets and the response to the coronavirus. The floor is now open for questions. Thank you very much, all of you. Thank you all again very much for joining us. We're now in the live Q&A session. Thanks to those again who've already messaged in your questions during the panel. We have a couple of questions here already that have come through. So let's start tackling them one by one. The first question is for Jason. The question is, Jason, you mentioned some development projects that could be linked to COVID and social uses of proceeds. How broadly are investors looking at COVID or social investments in Japan? And what kinds of less intuitive projects could be considered social?
Thanks, that's a great question. I would say, first of all, we have kind of looking over at some of the, there has actually been quite a lot of Japanese social bond issuance this year and recently. Some of the ones that I think are kind of interesting, just that have already been put out into the market. Obviously we've seen quite a lot of banks starting to issue now social bonds around COVID for SME finance. That's obviously a big need here. We've actually seen some infrastructure companies and some real estate companies that are working on building either infrastructure, more infrastructure links out to the rural areas of Japan, where there's been actually a depopulation trend, as well as some real estate development projects to revitalize those areas, in anticipation that going forward, that there could be a shift, with more telework and stuff like that, that there could be a more demand for that, for people to live in those areas, which I think is kind of an interesting and way to do it. You don't want to be just fighting the last battle. Thinking of how do issues around COVID, around this this year's issues, how does that sort of merge with the country's own national kind of circumstances and longer trends that will be paying off and be worthwhile social investments down the line. We've also seen a Japanese airline has issued a social bond. That was actually last year, not COVID related, although perhaps there's space there. So there is there's quite a paucity right now of industrial bonds in the COVID social bond space, but it would definitely be interesting to see more innovative thinking in that field to give investors more diversity. Thank you.
Okay, thank you very much for that, Jason. We have another question here. How much cross-border investment has there been in Asia in social bonds and COVID bonds in particular, or are investors mainly investing domestically? Martine, do you want to tackle that?
Yes, I mean, I can certainly speak from AIIB's experience. So as I mentioned earlier in the panel, we have actually issued our debut Panda this year, and the Panda had the virus prevention label. And what was really, very interesting for us with regard to the end result of that transaction was that 65% of the Panda bond was actually sold offshore. So in actual fact, it was 65% sold into the Asian region. So we had 35% onshore and 65% offshore. And with the other bond that we did was our SEC registered global, which we did in May, and that was in the context of COVID-19 as well. And that transaction was actually sold 50% into Asia, 20% into the US, and 30% into EMEA. So definitely a lot of interest from, across border on those transactions.
Okay, excellent. And Jing, do you want to share anything from CCB's point of view on that in terms of cross-border investment or whether investors are mainly investing domestically?
Well, sure. For the domestic investors, I believe there are other financial institutions, just like CCB. They all had certain funds to invest on social concept bonds. Also, according to our observation, offshore investors are really active in this field. For example, in the green bond market, actually, we have seen that more and more Bond Connect investors are pouring in to invest on the green bonds issued in China, because for now the green standards in China is getting more and more aligned with international standards. We believe such trend will continue.
Okay, thank you very much, Jing. Yet another question for AIIB, Martine. I understand that AIIB has launched an investment framework for climate change recently. Why is this investment framework needed, and what does it allow investors to do?
Oh yes, thank you. That was actually something that was launched only a few days ago together with Amundi, and it's also endorsed by the Climate Bond Initiative. And it's basically a knowledge product that has come from our Asia Climate Bond portfolio. And that portfolio itself is $500 million, and it's managed by Amundi to invest in labeled green bonds as well as unlabeled climate bonds of so-called climate champions. So those are, issuers that are expected to outperform in the coming sort of climate change environment. And so not only that, the framework provides a mechanism to help companies transition their business models and become tomorrow's climate champions. So the result is that we help investors to align their portfolios with the goals of the Paris Agreement. But in addition, we also help issuers become tomorrow's climate champions. So that means that then they will be eligible to actually, for us to invest in them through the fund and through the framework. And so basically we're ensuring that there is financing available for sustainable projects going forward. And the key to the framework as well is that it's not proprietary to AIIB and Amundi. What we're really hoping for is that we'll get other private sector parties involved with us, so that we'll be able to, increase that ability to invest in those climate champions.
Yeah, that's great. Thank you very much, Martine. We have yet another question that's come in. Jason, perhaps you may want to tackle that. Are all coronavirus bonds social bonds? And do investors immediately look at coronavirus bonds as an ESG or social bond?
Okay, so this is a very good question. I've actually been researching this just recently for an upcoming piece with the Asia Development Bank. So COVID bonds is a subsector of social bonds, typically, although sometimes we have seen a couple of cases where a bond has been issued with a COVID label or a coronavirus, a pandemic kind of response label, but not actually being in line with either a social bond or the sustainability bond principles by ICMA. So certainly there's a big need for financing around this issue, and I think it's also fair to say that not every issuer is going to have a social bond or sustainability bond framework just ready to go at the drop of a hat, especially with all the disruptions that we've had. So it may be sort of something that people are doing, maybe not a fully formed ICMA type of social sustainable bond, but you do see these bonds coming out now with some regularity. I think it depends on the investor how much they want to stick to the ICMA. Typically, we do want to see high quality issuance that goes with those standards. But in the case of one very large EM sovereign in the Asia region, they were very fast to get out a pandemic response bond. Actually, I think in April, and they were able to print a very large size using a kind of an established format, and it seems that they were able to raise a lot of money for their sovereign, even in a very challenging market condition. So I think it's definitely something that people are looking at, and if given the choice, you'd want to see some kind of link to pandemic response there. Thank you.
Okay, great, thank you.
Rashmi, I think I'll also add to that, if possible. So AIB, as well as people like IFC, did have like rapid COVID response sort of facilities that rolled out after the pandemic to support clients. And of course, on the back of that, we had our first inaugural social bond issued by the IFC in March. And so that was to support some of the rapid response facilities that we were rolling out to clients in response to the pandemic. And those were across, for example, the real sector and the financial sector, mainly to provide liquidity. But going forward, in phase 2 of our rapid response to the pandemic, we will be looking at different platforms that support, for example, health and so forth. And on the back of that, we may have like some issuance on the IFC side with social bonds to support those kind of COVID-related responses. Thank you.
Okay. Thank you, Christina. We have one other question here. Do you think more progress will come from investors allocating money to specific portfolios that target ESG progress, or from investors taking more care about these issues right across their whole portfolios? Jason, this sounds like it's one more for you. Sure.
Well, I would say, from our own perspective, from our own experience at Nomura Asset Management, we certainly came in and we saw, the growth of the green bond market, the growth of the labor bond market, which I think has been, from what I can tell, a big focus for fixed income investors. The label kind of tells you that this is what it is, and you can sort of say this we're doing an ESG investment as a fixed income investor. For us, I think we really needed to have a broader palette. So our approach thus far has been more to put together, a quantitative model for assessing ESG risks across, on industry-specific materiality across basically every single industrial sector and also in sovereigns. And that basically gives us almost kind of a universal scope to invest in kind of coming around to the AIIB has just launched, what we call, green champions or ESG champions. So we're actually picking the best performers that we also think have the best financial, investment ups, all happening at the same time, done basically one of our credit investment strategies now. So that's the approach that we've taken. We think that that's, for right now, it works for us. It really, you can really apply that basically universally, and I think that is how you really very quickly reach a mainstream status for ESG investing, which hopefully sends a signal through the market that this is something that investors are looking at. This is something that we're assessing on, and if you want to be put into the portfolios of these investors, you need to be taking that seriously and performing at a high level with the industry material ESG factors for you. Thank you.
Okay, excellent. Thank you very much. Which brings us to quite an interesting question. Is there an end date to when we will be speaking about COVID bonds? It feels like this label or association can be used for recovery-related fundraising for some time, particularly if you're applying the use of proceeds fairly broadly. I'm guessing all of you have your takes on this. So Christina, do you want to maybe start first and then we can go around?
I think that's a very interesting question. I think on the IFC side, we definitely see the recovery post-COVID being pretty long-term. And a lot of work has been done recently by ICMA and others to look at what they're categorizing as, social issues that would apply to social bonds. And I think COVID brings up a lot of those. I mean, wherever you look, whether it's, vulnerable populations, health, we see that there would be long-term opportunities actually for social bonds to be issued. And on my side, we work a lot with issuers that we would like to bring to market. On the capital market side, I don't work in a treasury function, but rather on the investment side of the IFC. And we do find that there may be a lot of opportunities, for example, with the financial institutions that we work with, to come and issue. They wouldn't have had the volume to do pre-pandemic, but I think there are a lot of things that would give us opportunities to look at prepping issuers for assets that are related to the effects of COVID. So I think this is a long-term trend for sure.
Okay. Thank you, Christina. Martine?
Well, our crisis recovery itself facility, it actually ends in October of next year. So in other words, it is for approved financings until October of next year. And so certainly we want to be able to be referencing the facility where we think it's appropriate on all of our debt issuance going forward. But I think the key to the recovery will really be partially in infrastructure. And so someone like AIIB is really set up to be able to help with the recovery process through our ordinary debt issuance. All of the sustainable development bonds that we issue, of course, are all intended to be able to allow us to approve projects in infrastructure, which is obviously going to be essential with the pandemic.
Okay, great. Jing, let's hear your take before I move on to Jason to round things up. What do you think, Jing? Is there an end date to when we'll be speaking about COVID bonds?
We think that the social concept will definitely continue to be a hot topic in the capital market, especially in China. Such kind of concept are special bonds, such as the poverty alleviation bond, or the kind of bond that support the entrepreneurs are very rapidly developing in China. The COVID-19 had given us a sign of the urgency that we need to pay more attention and raise our consciousness on the social concept. So we think that such social bond related product will continue to develop.
Great. Jason, over to you.
Sure, thanks. I agree with all the sentiments. I mean, clearly, I think I speak for all of us, the sooner we can close the book on COVID pandemic, the better. But clearly, the damage is broad and deep, and there will be a lot of issues going forward that the fixed income market can address. SME financing to rebuild, as I mentioned, kind of areas where COVID, the issues that we've dealt with COVID, kind of merges into longer term issues. That's certainly an interesting area. I mean, also I think it's kind of interesting how it's shown how in some other ways how fragile like our supply chains are for medical devices, for medicines. I think that there should be some thought put around what do we need to do to build resiliency into those areas as well. So clearly, I think it'll be a long-term issue that we're dealing with. And overall, I think it's really raised awareness within the ESG investment world that it's not all about just green and kind of climate change investments. There are a lot of things to be done on the social side. So I think that's also another trend going forward. Thank you.
Great, thank you very much, all of you again. Thanks again to all of those who sent over your questions for this panel. We're nearly at the end of it. So thank you again to all of you for taking the time to speak to me today. We have a very short break, but coming up next, after the break is a keynote interview with Cyrus, Adeline, Chairman of the Board of Directors of the International Finance Facility for Immunization. This is a firm that had dispersed nearly $2.6 billion to vaccinate children in developing countries. So please stay tuned for that. A keynote interview with Cyrus, Adeline coming up next at 10:15 a.m. Thank you very much.